and this is Nvidia. And if you look at it, it's pretty much the same chart. Now, this is Nvidia. We just looked at Eli Lilly, and that's a 6-month chart. This looks like it's closer to a 1-year chart, but you can see it's the same chart. It's in the upper, and this is all from last night when we put this together. It's in the upper right-hand corner. It's over base of price support, 850 to 900. Same thing. My moving averages are stacked. 20-day over the 50-day, 10-day over the 20-day, 50-day crosses. And if you go through and look at my buys for the most part are going to be charts that look just like this and charts that look just like this, because the way that I'm geared is I don't like overhead resistance. I don't like to buy stocks that are weak. So I'm looking for stocks that are breaking out of the base and ideally over support.
Welcome to Blue Chip Daily, one of the industry's premier sources for high-level daily technical and trend analysis. Blue Chip Daily is ideal for both investors and traders of all time frames who want to be on the right side of major market moves and trends. We focus on over 750 large cap stocks, all major stock indices, over 70 exchange-traded funds, bonds, oil, gold, and Bitcoin. Sign up now for Blue Chip Daily, and you will get access to real-time portfolio alerts, premium Twitter page with intraday alerts and commentary, the chart of the day with best idea, daily video and report, and much more. Claim 30-day trial at www.bluechipdaily.com.
One of the things that's really important in trading is, how do we see trends and how do we follow trends? And in addition to seeing a trend, we know that rules are really important to help keep you in a trend and also to give you indication of when the trend might be ending or slowing down. And so tonight's speaker is Larry Tentarelli, and his talk is Don't Fight the Tape, 10 Position Trading Rules, which I think will be really, really useful to many of us. Just give me some background on Larry. He is the Chief Technical Strategist, and he's the founder of Blue Chip Daily, his own service. Now, Larry's been trading for a long time. He's been trading since the 90s. He has also is a Series 7 licensed advisor with Merrill Lynch since 1998. Then he made his move to eventually developing his own proprietary technical process. He has a huge daily following of readers on X since 2013 when he joined. He's got over 90,000 readers that see his posts and follow him. He has a great track record of consistent picks, great market calls, and some of his commentary has been on CNBC and Bloomberg and all the other media outlets. So it is a pleasure to have Larry with us today. And with that introduction, I will turn it over to you, Larry.
So I'm going to start just with a minute about me, just so people know who I am. So as you said, I started trading in 1998. I was with Merrill Lynch for 5 years, Series 7 licensed. I went on to start my own website, and I wanted to learn how to trade for myself and invest for myself. I wasn't really big on the retail brokerage side where it's a lot of hand holding. It's a lot of daily conversations. Why is the market up 2 points? Why is it down? And I wanted to trade for myself. So as you said, I've been on Twitter for a while. I've been on CNBC, Bloomberg, my recent TV appearance on Bloomberg last month. I was happy to see that. Your viewers can find me on Twitter at Blue Chip Daily. My website is bluechipdaily.com. And then we'll go into the disclaimer. Then we'll get started because I know that's what people came here to see, not so much about, my Twitter page. But I'm going to talk about what is position trading, and then we'll go right into the 10 steps. Time frame, method, the markets that I trade, charts and indicators, entry signals, risk management, position sizing, risk management, stop losses, scaling winners, closing positions. And then we'll talk about some winning tips from Paul Tudor Jones. But what I really wanted to do up front is just show everyone, here's the 10 step and here's what we're going to get into. So a couple things. I'm going to share with you key rules and concepts that I use, but this is not going to be an out of the box trading system. I'm not going to try to convince anyone that my way is better than their way or that my way is the only way that works, because it isn't. There's dozens of ways to make money in the market, but my way works best for me. So I wanted to share what I do, what my process was, and what steps I follow every day. But this is definitely not where I'm going to say what I do is the best and what everyone else does isn't good, because that's not how I view things at all. So position trading, my definition, and everyone has their own definition. I'm going to move my camera over just a little bit here. So my definition is a 3 to a 6 month or a 6 to a 12 month time frame. Now we'll talk about that a little bit some more. It's not day trading. It's not swing trading. It can be similar, but it is not identical to trend following. So traditionally, pure trend following is systematic. You can build a scan, you can run your signals, and when the signals generate, you take a trade. So for me, position trading is discretionary. It can be systematic, but I can't say that I am not a 100% systematic trader. I do use discretion. And then we'll talk about reactive versus predictive. And I think this is the key thing. So reactive, what I do is I look at a chart and I react to what's happening on that chart. With a predictive trader or a predictive investor, and we see this mostly on social media, is, somebody might go on social media and say, well, based on this, that, and the other thing, I think gold is going to go up, or Nvidia is going to go down, or the stock market's going to crash, whatever it is. That's predict, and it's usually based on what somebody thinks about the market in their head. What I do is I dial into a chart, and what I see on that chart tells me what I'm going to think. So I'm a reactive trader. I'm not a predictive trader. So when it comes to time frame, I borrowed this from Stan Weinstein's book, and I think Stan Weinstein is one of everybody's favorites. He's definitely one of my favorites. And his book, Secrets for Profiting in Bull and Bear Markets, it's one of my top 3 books by far. So I borrowed Stan's time frame. So Stan considers a trader someone that's looking for a 2 to a 4 month time frame. Investor, and this is Stan's time frame, up to 12 months. Short term, he's talking about 1 to 6 weeks. And so for me, I would say that swing trading probably falls into that 1 to 6 week time frame. So I'm somewhere in the middle between a trader and an investor. And really the sweet spot for me is generally 3 to 6 months or 6 to 12 months. And we'll talk about that some more. But when it comes down to rule number 1, I think what it's important for everyone to do is focus on one time frame. And what I mean by that is there are great day traders. There are great swing traders. There are great position traders. I don't personally know anyone that's great at all 3. So I know a lot of people that like to day trade and swing trade, and that's great. And they're good at it, but maybe they're not so good at the longer term game. For me personally, I'm not a good day trader whatsoever. I could swing trade, but I prefer to look for that 3 to 6 month window. But what rule number 1 would be is I think everyone needs to figure out what is their sweet spot for time frame and then dial into that. So work on excelling at one time frame. Don't drift. And here's what I'm looking for. And then I'll share some of my positions from the website. So I'm looking for positions that I believe can give me 20 to 25% over a 6 to a 12 month period. But I'm also looking for home run trades. And for me, a home run trade is if I can get 50% or more out of a position in 12 months, then to me, that's a home run. But that's what I'm looking for. I'm not looking to really, buy something today, make a couple points, and then get out and buy something else, because I'm not geared for bigger turnover. So what I did was I took this off my members' website, and this is from last night. So members have access to everything 24/7. So when they join the website, so where these things say members view, the members actually see all of it. But what this shows, so I've been on a good streak. Now I do have some losers in there. So we'll look at the losers in a minute, because I'm not going to come here and tell you that everything that I buy is green, because it's not. But I do have a pretty good streak going right now. But if you look at some of my positions, I've got some open positions right now. So this is triple Q. This dates back to March 14th of last year. I'm up 54% in that. Now I've got some recent positions that are up 0.5%, down 1%. This was screenshot last night. So as of today, I did take a hit. Some of my copper positions are down. Some of my gold positions are down. But you can see I've got positions here from December of last year. I've got Nvidia from May of last year. I've got Eli Lilly. That's about 6 months old. Novo Nordisk. That's about 6 months old. So I've got a combination of stuff that's 6 to 12 months old, but then I've got a combination of things that I just bought in the past week or two. So as far as closed trades, and I don't show the open positions just to show what they're doing. I show it to reflect that what I do is I gear my time frame with what my mindset is. So if I'm looking for, let's say, 50% in a year as a home run and 20 to 25% on average, that's what I'm holding right now, is a lot of those positions. Now, I did have positions that got stopped out. I've got positions that got closed out, but as we get into money management, what you're going to see is that the positions that I've closed, and they're in green, the winners are going to be much bigger than the losers. And I could hit a streak, and I was really active on the sell side, and I didn't want to be. But you can see here in March, I didn't do much of anything selling. But then in April, I had to sell. I sold a lot of stuff. I didn't sell out of all of it, but I scaled out of some of it because it was earnings. I did get stopped out of Netflix before that turned higher. But basically what I'm showing in my closed positions is obviously I've got losers too, just like everyone else does, but I try to match my time frame with my mindset. So number 2 is method. And once again, what I want to do and what I would advocate for people to do is focus on one. So you could be a technical trader, you could be a fundamental trader. Some people use both, but here's the key thing. You only have to excel at one thing. So I'll go on Twitter, and I've got a lot of friends on there, and I'll see, one day we're buying, AI stocks, and then the next day we're shorting gold stocks, and then the third day we're doing something else. And for me, that falls into the box of you can't be good at everything. Me personally, I'm not a good short seller. There's a lot of things that I'm not good at, but I've realized that over the years that I'm not good at this, and this. So I just eliminated that from what I do, and then I focus on the things that I am good at. So I would say strive to master one time frame and one style. If you want to be a technical trader, be a technical trader and work on that. If you want to watch CNBC all day and trade off the headlines, you could do that too. But it's hard to do, be a technical trader, be a CNBC person, and do all that. I would say figure out, and this is a personal it's a personal journey trading, because there's people that do it many different ways and make money. But what every person needs to figure out is what works best for them. Because, John, what works best for you and what works best for me might be two different things. So don't try to be a jack of all trades. Wait for your best signals. Stay consistent. Don't overtrade. And it can be tempting. And I miss stocks every day. I was talking today about First Solar. So I missed First Solar. It's up 25% in the past 2 days. I put out an alert for my subscribers yesterday, but I told myself, because we had Nvidia's earnings tonight. I've got Nvidia, Supermicro, I've got Vertiv Holdings, I've got the semiconductors ETF, and so those 4 alone, if Nvidia went down, all 4 of those positions are going to go down. Luckily, the last I looked, Nvidia was going up, so those positions are going up too. But I told myself coming into this week, I just wasn't going to take any trade, because if Nvidia missed tonight, and they didn't, but if they did, not only would all 4 of those positions be going south, but anything that I bought this week in tech would probably go south. So I had to wait and watch First Solar go up 25%. But you have to learn that if your plan is to not do anything, I think you have to learn how to follow that plan. Number 3, Mark, and if it's okay with you, what I'm going to do is I'm going to put my phone up so I can see my clock, because I can't see the clock on the computer. So I want to be sure I don't, get carried over into any one subject. Are there any questions that came in so far that you wanted to bring up?
Monitoring the chat though.
Okay. Because if not, I'll just keep going, but I'm sure people might have questions. Any questions, or should I just go?
Nope, just keep going.
Okay.
Good.
So number 3, and And when I share this with everyone tonight, this is a process that I went through over the course of probably 6 years. So to give people a little background and dial it back for a second, I started trading in 1998. I was a broker with Merrill Lynch. For 2 years, everything went up. And then for 3 years, everything went down. So I blew up a couple times. I blew up a couple trading accounts. I decided I was going to stop trading. And then, 3 months later, I went back and then I decided, and then I blew up another account. So between, 98 to 2000, I made money. It was easy. And then 2000 to 2003, when the markets unwound, I probably blew up 2 or 3 accounts. I was over trading quite a bit, and I was just lost. I would overtrade. I had no idea what I was doing. I didn't know how to read a chart. So sometime in 03, I was sitting at home and I looked at all the money that I lost, and I said, I love the market. This is what I'm meant to do. But obviously, I got beat up pretty bad in 01 to 03. So what I wanted to do is figure out, what did I do wrong? And then how could I avoid doing that in the future? So I started to look at charts, and because I didn't really know how to read charts when I first started. And what I noticed, because I had everything, I had Cisco, I had Sun Microsystems, I had EMC, Nortel, JDS Uniphase, and they all went down 80 or 90%, right? So I got blown out. And what I figured out is I discovered the 200-day moving average. And as I looked at these charts of these stocks that, went down 80% with me in them, I realized that if the only thing that I did was when that stock hit the 200-day moving average and broke below, if I just sold those stocks when they went below the 200-day and I didn't buy them, if that was the only thing I did, I would have had, a whole lot more money. So that's really what got me tuned into starting to learn technical analysis, because I said to myself, I'm a horrible discretionary trader. Now, I'm much better now than I was 20 years ago. But back then, if Jim Cramer came on and said, buy XYZ, I would buy XYZ. I didn't know what I was doing. So I wanted to develop a system for myself to save me from myself. So I wanted to develop a rules-based trading system. So what I'm sharing with everyone tonight is a process that I went through over, maybe 3 or 4 years of putting a pen to paper and trying it with real money and trial and error. So number 3, because we're going through the 10
Hey,
steps.
Larry, I do have a question for you on the slide. You're showing 10 billion in market caps, 820 stocks, and the 80 unlevered ETF. Someone asked, that's your universe. You're not holding that many stocks.
Exactly right. Yeah,
Okay.
great. That's a great question. I would be a pretty big hedge fund if I did that. But here's what I wanted to do. I wanted to avoid just buying random stocks and looking at random stocks. So what works for me is I stay in the large cap universe, $10 billion and higher, 820 stocks. And when I run my FinViz screener, and I've got a slide for that, when I run my screeners and I've got preset alerts, it's really in that $10 billion and up range. And then I've got 80 unlevered ETFs that I track every day on a daily basis. And that's where I run my screener. And it's everything. It's Bitcoin, it's gold, it's China, it's everything. But
I had a question. People want to know, do you ever trade levered ETFs?
I personally don't. And the reason is, to me, because I studied it, is there's no benefit to me from a 3x ETF. And what I mean by that is if I'm going to buy an ETF and run, let's say hypothetically, a 10% stop, if I buy a 3x ETF, then in reality, because it's 3 times levered, I have to run, in reality, it would be a 3% stop. You see what I mean? So the markets that I get into, if I'm in triple Q or something like that, if I buy triple Q with a 10% stop, if I buy the 3X ETF, my real stop is only a 3% move in triple Q, and that's too tight. So there's nothing wrong with the levered ETFs, but I think you have to run super, super tight stops, and you have to be prepared for, a lot of volatility. And I'm just not good with super tight stops. So I'm more comfortable just putting, more money into triple Q and then work with it that way. But what I think everyone should do is first decide, what is your universe? Because at 820 stock, I can't get every stock, but I can get enough. I can get exposure to every single market. Some people might just do small caps, but what I would suggest is figure out, where are you most successful when it comes to stocks that you trade, and then focus on that. Have a basket of ETF. But the reason that I do that is so that I don't wind up buying a bunch of micro cap stocks and small cap stocks, just because that doesn't work for me. So whatever your universe is, I think you need to define it, and then stick to that basket, run your screeners on that basket wherever it is. So we're going to spend more time now on charts and indicators. And here's my belief. I want to keep everything simple and keep it consistent. And what I mean is over the years, I've read, realistically, probably 60 or 70 books on technical analysis. I've got a book, and I've got this. Well, it's up there. I won't get it, but I've got a book in there that's got a breakdown of like 60 different technical indicators. And you just can't make money trying to trade 60 different technical indicators every day. So what I did was I just researched them all, and I said, okay, what are 2 or 3 that work for me that I can use every day on a daily basis? So what works best for me, number one, is price. So I look for base breakouts. I look for upper right-hand corner breakouts. I focus on support levels and breakout levels quite a bit. But then for me, it's moving averages and it's relative strength. Now, here's the thing. Some people might say, well, moving averages are good or moving averages are bad, or, I use the MACD or I use stochastics or whatever. It doesn't matter what you use. As long as you're comfortable with it, you can make money with it and stay consistent. But what I don't want to do is I don't want to look at a chart one day and say, well, the ADX indicator is giving me a buy signal, so let me use the ADX on this chart, and then I'm going to look at another chart and I'm going to use the stochastics on, that I don't want to do that. I just want to dial in. So what I would recommend that people do is find 1, 2, maybe 3 indicators that you're comfortable with, that you get pretty good results with, and then focus on those and don't worry about what the other indicators say. And then the last thing here is I want to have clean charts. So what I mean, and I'm going to move this little box up so I can see my chart, but this is one of my charts. So I share my charts, all day with my subscribers, and I share charts all day on Twitter. But this is basically what my trading chart looks like. So it's pretty simple. I've got 5 moving averages on there. I've got relative strength. I keep volume on there just to really have it on the screen so I can see it, but I do not have any volume requirements. Stocks can break out on small volume and keep going. You can get stopped out on no volume and it can keep going. So what works best for me is moving averages and price breakouts. And this was a chart that I posted a few days ago. But really what I'm looking for, my ideal chart, is an upper right-hand corner breakout. So what I mean is we can see this is Eli Lilly trading in the upper right-hand corner. And what I'm looking at is, number one, when the chart is over the top of a price base, then that's good. Because what that tells me is that I've got a pretty long base of support here where these people bought the stock and they're all profitable in their position. So I've got some buyers down here. Whereas if Lilly was trading down here and I had all this overhead resistance, what that would tell me is that there were a bunch of buyers that paid higher for the stock. And if the stock runs up into that, they're going to be met with sellers that want to get out of the stock. So number one, I like to stay in the upper right-hand corner of the screen. Number two, I like to see when the moving averages are stacked. So in this case, the 10-day is over the 20-day. The 10-day just crossed the 50-day. The 20-day just crossed the 50-day. To me, this is an ideal chart. And ideally, now I've got Lilly from somewhere down in here, but I could add to Lilly at any time. So if I'm looking to add, then adding in here would be fine, or buying this breakout would be fine. So I'll give you another chart because I use 2 platforms, and this is Nvidia. And if you look at it, it's pretty much the same chart. Now, this is Nvidia. We just looked at Eli Lilly, and that's a 6-month chart. This looks like it's closer to a 1-year chart. But you can see it's the same chart. It's in the upper, and this is all from last night when we put this together. It's in the upper right-hand corner. It's over a base of price support, 850 to 900. Same thing. My moving averages are stacked. 20-day over the 50-day, 10-day over the 20-day, 50-day crosses. And if you go through and look at my buys, I'll show you another one. Well, we'll get to it in a minute because I don't have it right here. I thought I did. But my buys, for the most part, are going to be charts that look just like this and charts that look just like this, because the way that I'm geared is I don't like overhead resistant. I don't like to buy stocks that are weak. So I'm looking for stocks that are breaking out of a base and ideally over support. And what we'll do in a minute is we're going to take a look at C, which is the stock that I just bought. And you're going to see it's if you covered up the symbols on all these charts, they're all the same chart. And so when I say keep it simple and keep it consistent, this chart formation works for me. So I want to keep going back. It's like in football. If you can run the football 4 to 5 yards of play and they can't stop you, just keep running the football because that's what's working for you. So but these are my charts. And these are the exact charts that I use during the day. So I don't have, 15 indicators or 5 indicators or 10 indicators. And I don't use Fibonacci and I don't use all. That's great. It works for people. But I don't need all that stuff because it doesn't work for me. So I just don't use it. So charts.
Here's a question for you, Larry. When you buy a breakout, from the upper right corner, how do you calculate a price target? Is it, I don't know, PE, or is it time based, or how do you know, or are you using technicals to tell you when to?
So I'm going to get into that. We're going to talk about when to, but so here's the thing. I don't use price targets per se. So what this means is, like, I can look at a chart if it breaks out and I can dial it up and I can tell you, well, if Nvidia clears 1,000, then the next target's probably 1,075. But I don't use price targets per se because I am a trend follower at heart. So the way that I look at it, and this is why I showed you those positions that I've had for about a year, is if the trend is working, I don't want to shortcut the trade. So I'm going to let it go as long as it's working. But when we get to the end, I will show you some things that I use to say, hey, maybe the trend is over, or maybe it's running out of gas and I should move on. So entry signal, this same thing. So this is step number 5, because we actually have to have a buy signal. Something has to tell us, okay, I want to buy this stock. So it can be rules-based or it can be discretionary. So I do use a little bit of discretion because, once again, I'm looking at 800 stocks a day. I might buy one, I might buy none because I don't trade that often. I'm not trading every single day. So there's a lot of discretion in what I do. But if someone wanted to develop a purely rules-based trading program, it's simple. You can set up a scan and you could say, I'm going to buy this stock if it breaks out over the 50-day high or something like that. So you can build automated technical scans, or you can use your own. So some basic signals. A lot of technical traders will use range breakout. So you could set your screener, run me a screen of all stocks that are making a new 20-day high, or a new 50-day high, a new 52-week high. So that's one way. You can use moving average price crosses. So a screen that I'll run quite a bit through the day is I'm looking for stocks that are trading over the 50-day and they're just now reclaiming the 20-day moving average. But once again, you can automate that. Then a lot of people, Mark Minervini, I know, uses VCP. And that works well for him. So there's a lot of ways that you can, develop signals that work best for you. But what I would say, once again, don't use a variety of signals. Figure out which one works best for you or which two work best, and then try not to do too much of that. And then I put down here, you can run scans, and I'll show you a scan in a minute, but you could run a scan that says, I only want to see stocks that are over the 50-day, over the 200-day, and they're making a new 50-day high. So when you run these scans, you can go from 800 stocks to, 20 stocks in a very short period of time. And we're going to get into that some more with entry signal. Now, here's something that I think is very important, and I did get this from Stan Weinstein. So Stan has what he calls the forest to the trees approach. And what the forest to the trees means is, number one, what's the trend of the market? Number two, what are the strongest sectors? And then what are the strongest stocks? And that's how I work, because if the market is going down, and here's the thing, it is a market of stocks. So we cannot debate that. It is a market of stocks, and you can have the entire market going down and a handful of stocks are going higher. You could have the market going up and a bunch of stocks are going down. What works best for me is if the S&P 500 is below the 50-day moving average, I do very little buying overall. So for me, I want to see the S&P 500 over the 50-day moving average, and ideally over a rising 50-day moving average, because here's what I know. And William O'Neill was famous for this. Not all stocks will follow the index, but most stocks will. So I want to be cognizant. Is the market in an uptrend? Because if it is, the rising tide tends to lift most ships. If the market's going down, that's when you tend to see a lot more failed breakouts. So I want to know what's the trend of the market. Then I want to dial into, and I do this just with relative strength screeners. So all day I've got all my industry groups, and my sectors are sorted by relative strength and how close they are to the 52-week high. So I want to focus on sectors that have strong relative strength and that are close to 52-week highs. And then I want to dial into what's the strongest stock in that sector. So strong market, strong sector, strong stock. And then, as I said before, my best bet is the upper right-hand corner breakout. So there's a few ways that you can do this. So I brought a FinViz screener. I use FinViz quite a bit, because I've just really spent a lot of time with it over the years. But this is just a basic screener, but you can see in FinViz, they've got, 80 different categories right here. But I just kept it simple. So this screen is large cap stock, price over the 50-day, price over the 200-day. Very, very simple screen. It tells me that there's 477 stock. And then what I can do, and this is what I'll often do to make it more refined, I can just run for stocks that are making a 20-day high. And then this 470 is going to go down quite a bit. Or I can scan for 52-week highs, or I can scan for 50-day highs, or I can sort it by relative strength. So they've got an RSI indicator. But what I'm really just trying to share with everyone is you can very simply go from a universe of 800 stocks or 1,000 stocks to, 15 or 20 stocks in a very short period of time, just based on how technical you want your screeners to be. Now, in stockcharts.com, you can build your own screener. So in this case, this is a scan that I built, and I've got a couple built in stock charts. And I use stockcharts.com and FinViz quite a bit because I've used them forever and I'm just comfortable with them. But in this case, I built a scan, and it just tells me, show me stocks that are making a 20-day over a 50-day moving average bullish cross today. If you want to see, stochastic crossovers, if you want to see MACD crossovers, you can build whatever you want to. But once again, I think the key thing is just focus on one or two. I don't want to, spend all day running, 20 different screeners and then it gives me 100 stocks. I'd rather just focus on, give me the strongest stock that are making a 20-day high or a 50-day high that are near breakout levels. But the key thing, once again, you can build your screens the way that you want and then figure out what works best for you. So just quickly, and I'm watching the clock here because I don't want to take up everyone's time. I'm going to try to get this done in about an hour, and then John, we can take questions how you want to. But C is a recent buy that I made. So I shared this on the members website. So on my website, I share with the members, obviously, real-time trade alerts. When I buy a stock, sell a stock, we send an email, we send a text, and it goes on the page. But so this is a buy from May 15th for C. $67. But if you look at the C chart, like I said, it looks exactly like the Lilly chart, It looks exactly like the Nvidia chart. It was in the upper right-hand corner. It was over the top of 5 rising moving. Maybe that 200 is a little bit flat, but it's over the top of all the moving averages. The moving averages are stacked. So that buy was at 67. Here's a little bit better look at the chart. So I posted the chart after the buy. So you can see it's in the upper right-hand corner, just like the other two chart. And then it closed yesterday 73 and change. I think it was up 8% or so. But it's just continuing. You know, the buy was, I think the buy was in here, and it's just continuing to drift into the upper right-hand corner. It's over the 10-day, it's over the 20-day, it's over the 50-day. And we can see it pulled right back to the 50-day, and it held there on the way up. So for me, if I see a chart that looks like this, I just bought some gold. I've got a recent position in Vertiv Holdings. I've got a recent position in the semiconductors. But, you know, my buys for the most part are all going to look like the exact same chart. You know, for the most part, there's always going to be one that might not be exactly in the upper right-hand corner, but it's going to be over the moving averages. I generally, I can't remember the last time I bought a stock that was below the 50-day moving average. I might have, but I can't remember the last time that I did. So number 6, risk management, position sizing. So this might be one of the most important aspects of trading and investing. And I did a podcast yesterday with Tom Basso, and he's really big with position sizing, and we talked about that for a while. But here's the thing. You have to know before you go into a trade how much money you're willing to lose. And the reason that I say that is the only thing that separates people that are in the markets for, you know, 20, 30, 40, 50 years and people that might wash out after, you know, 6 months or 2 years is risk management, because we're all going to hit drawdown. We're all going to hit bumpy markets. We're all going to hit a period where we get a series of stops that go off, and it's key that we don't run out of money. So position sizing is one of the most important things that professionals focus on that novice traders and investors really don't know anything about. And I didn't know anything about position sizing probably for the first maybe 6 or 7 years. I didn't even know what position sizing was. I just bought a stock and, you know, I just put a random amount of money in. So you have to determine, and this should be in writing, how much are you willing to risk? If you buy a stock and you get stopped out, how much are you willing to risk in that one position? And then how much are you willing to risk if they all get stopped out? And the reason that I say that is you could run into a market like in 2020 where most positions get stopped out. So every position gets a hard stop in the system for me at the buy, and I'll talk about that some more. But here's the basic concept. The biggest rule that I know that most professionals follow is not to lose more than 1% of your account equity in any one position if you get stopped out. Now, a lot of professionals will use less than that, 50 basis points, but the high side is generally 1%. And then I want to have a 10% total stop loss limit on my account. Now, what I mean by that, it's not a 10% drawdown. So I don't monitor my drawdowns. I mean, I know where my high water mark is. I can look at my brokerage platform and, you know, it'll say, okay, here was your high water mark. Here's where you are now. But I don't have a cap where if I have a 5% drawdown or a 10% drawdown, I shut things down. But what I do have a cap is on risk versus my equity. So what I mean is if I buy Nvidia at 500 and it goes up to 1,000 and then it goes down 20%, that's not a problem for me as long as the trend is still intact. But if I buy Nvidia at 500 and it goes down 20% and I'm in it, that's a problem. So there's a difference between risk to your actual capital and a drawdown. Drawdowns don't bother me that much. Losing actual capital does. So what I mean by 1% max risk, $100,000 sample account, and I just use that because it's a round number that everybody can equate to. If you take a 10% position, so you take 10 grand of your 100,000 and you buy advanced micro device, and you put a 10% stop on that 10% position. If you get stopped out, it's going to cost you $1,000. You've got 100 grand, you put 10% into AMD, that's 10 grand. You run a 10% stop, your stop gets hit, you lost $1,000. that's 1% of risk. So I don't mean you can only put, $1,000 into a stock. If you get stopped out, it shouldn't cost you more than 1% of your actual account equity. If you've got $1 million account, then you don't want to lose more than $10,000 if you get stopped out. That's 1%. Most people that I know, for the most part, that are trading bigger amounts of money, generally run 50 basis points of risk. So in that case, $100,000 account, you took a 10% position, you used a 5% stop. If you get stopped out, it costs $500. Where you could take a 5% position, give it a 10% stop. You can do the math any way that you want to, but the bottom line equation is, if I buy this stock and it hits my stop, how much money did I lose? And ideally, that number should not be more than 1% of your account value. Now, I do know some swing traders, some professionals that will trade, only 2 or 3 positions at a time. And, they might, instead of having 1% of risk, they might run, 2 or 3% of risk, but they're only in 2 or 3 positions. So if they all get stopped out, they're not out of business as far as that goes. But once again, if I'm just setting up a system, 1% max equity risk, ideally 50 basis points. So we're going to talk about stops some more, but just quickly.
Hey, Larry,
yes.
Sorry to interrupt. I mean, the risk management stuff is so important. And you've done a great job at breaking it down. And I think the concept that I think I would emphasize even more is, and you touched upon this, is knowing your open risk of all the positions. And theoretically, what if they get all stopped out on a really bad day in the market? How much of a hit is that going to be? And you have to ask yourself, is that acceptable to have that much open risk, or should you be raising stops or selling positions? And people sometimes don't think about all the open risk that they have, as well as the concentration in a sector. So for instance, if you have 5 positions, you say, well, they're 5 positions and they're all 1%. But if they're all, chip stocks,
right,
and Nvidia disappoints, you say, oh my God, in a blink of an eye, all my stocks got clobbered. So
right.
Understanding your sector concentration and open risk is a really, really important for everybody to be very, very aware of what the whole portfolio.
Yeah, I mean, that's a great point. So I've got some copper positions. So I've got the Copper Miners ETF and I've got Tech Resources, but I constantly go over with my members almost every day. Listen, when they break out, it's great. You're glad that you own them. But when they pull back, they all pull back at the same time. So today, copper was down, silver was down, gold miners were down. Same thing you said with AI stocks. If Nvidia would have missed tonight, then, a lot of semis would be down, Dell would be down, Supermicro, Vertiv. So yeah, if you might buy 5 semi stocks and say, well, I've only got 1% of risk, but actually you have one big 5% position because they can all get hit at one time. So here's another very important thing. It's important to understand your volatility. So here's what I mean. So I'm not a believer. I know some people that use a fixed percentage. They buy a stock and they set a 5% stop, and that's what works for them. But here's the problem. So I brought some AI stocks with me. So if you look at Supermicro, the weekly volatility range for Supermicro is 8.5%. If you look at Taiwan Semi, the weekly volatility range is 2.4%. So what that means is that on a weekly basis, Supermicro is almost 4 times as volatile as Taiwan Semi. And I think if you look at the daily range, the daily ATR, I think that Supermicro is probably 4 times as volatile as Taiwan Semi. So it doesn't make any sense that I'm just going to buy stock and set a fixed 5% stop or a fixed 8% stop if one stock is 4 times as volatile as the other stock. Because if I buy a stock like Supermicro that trades in a 7 or 8% daily range and I set a 5% stop, I'm going to get stopped out probably the next day, because this stock trades in Supermicro is $900. So an 8% range is $72. If I set a 5% stop, that's $45. if Supermicro moves $72 a day in a range and my stop is inside that 1-day range, I'm going to get stopped out just based on volatility. So when I set my stop, if I buy a stock like Supermicro, I'm going to buy a smaller position and it's going to have a wider stop. Bitcoin is the same thing. I've got the Bitcoin ETF. I've got a wider stop. If I buy something like Microsoft, because it's so much less volatile, then my stop is going to be much tighter on that position. But it's important to look at the volatility in your stocks. So systematic traders, the way that I learned is systematic traders use ATR, which is average true range. And what that does is that takes the stock's volatility into account. So if a standard system that I learned was a 3 ATR stop. So if you use a 3 ATR stop on Supermicro, that's a 21% stop. But that's the way that a systematic account that uses ATR is going to trade that. And on Microsoft, a 3 ATR stop might be a 6% stop. So what I'm basically saying is I don't want to use the same stop level for every stock. I want to look at the volatility, and stocks that are more volatile need a little bit more wiggle room and maybe a smaller position size. So for me, every position gets a hard stop. My stops generally range anywhere from 6% to 15%. What I do is I do dial up the chart, and I look at the chart, I look at where my entry point is, and I look at the chart, and I'm looking to hide my stop underneath a price support level. I'm looking to hide it underneath a moving average where it shouldn't get hit. But I want to put my stop underneath some support. I want to have that defense. And what's going to happen is if the stock is extended and I can't find a logical place to put a stop, then I just can't take the trade, because I don't want to just donate my money and put a stop at some random place on the chart where there's no price support whatsoever. Key thing, you have to, using stop losses is probably the hardest thing for newer traders to accept, and it's probably the easiest thing for more experienced traders, because with experienced traders, stop losses, it's like your auto insurance policy. It's the way that you sleep at night. You say, okay, if I'm wrong on everything and I wake up tomorrow and it's all bad, I'm going to lose, 5% of my capital, whatever it is. And I got this from Paul Tudor Jones. He said every day he assumes every position he has is wrong. So I read that probably 20 years ago. And I said, geez, this guy is he's one of the best in the world. And he goes in and every day assumes everything that he has is wrong. And that taught me a lot about humility and how to be humble, and don't look at the stock market as a personal attack on you if your positions are wrong, because, this guy is one of the best ever. And he said that every day he goes in and he assumes that everything is wrong. So, it helps me when I get stopped out. I don't take it personally. Scaling winners, you don't want to sell your winners too early. And this is a big conversation, but I'll make it quick. So the position trader's mantra is to ride your winners and cut your losers short. Now, I'll go on social media and often I'll see a lot of things about selling into strength and selling into strength. And I get that, and that's good. But the problem is if I constantly sell my positions into strength, then I'm selling my strongest position. And I don't want to sell my strongest positions. If I've got a football team, I want to put my best players on the field. So if I'm constantly selling my strongest stock, then, what do I have left? So for me personally, I tend to hold my winners longer. Now, I will scale. So what I mean by that is if I've got a position and it's a 4 or a 5% position and the stock has a big move and maybe it's up 20 or 30% in a short period of time, maybe I'll dial back and sell 20% of the position or sell 30% of the position. But what I don't want to do is I don't want to, we looked at my open positions, and I think my first buy for Nvidia was $280 last May. If I sell Nvidia, if I buy it at 280 and it goes to 320 and I say, oh, it's great, I made 10% or 20%, and I sell it at 350 and the stock's $1,000 a year later, I'll never forget that, because I can remember every single stock that I sold too early. Last year I got stopped out of Supermicro at 250 and it went to $1,100. I got stopped out of Celsius Holdings right at the very low. I was probably the last person that sold it at like 50 and it went to 100. So I don't I don't, stocks that I get stopped out of and I lose a little bit of money, I pretty much forget about it the next day. But the stocks that go up big without, I remember them. So I would rather, if I'm up 10% in a stock, to be, completely candid, I would rather give back all that 10% profit, which to me is not a big gain. I'd rather give that 10% back than sell it at plus 10% and then watch it go up 50, 60, 70, 80%. I'm not geared for that. But everybody, everyone is geared differently. There's some people that make their living on 3, 5, 7, 8% wins, and that's great. I'm not saying that that's bad. It's just, it doesn't work for me, because I'll sit in my office for an hour and stew over that super micro stock that I got stopped of, and it went up higher. So if I get stopped out, doesn't bother me.
Yeah, this is another great point is, and it goes back to your number one thing you said, is know your time.
Yeah.
Because, like if you are a position trader, in order to get through from, a 1 year or a 2 year run, there are going to be corrections.
Yeah.
You're going to most likely go through some bases, and bases could be 10, 20, 30% deep. If you're not willing to do that, then there's something not in alignment with your system, because you're not going to capture it, because you're going to sell too early, you're going to get emotional, and you're going to basically bust your trading plan. So time frame is really important to understand what you're trying to achieve. And then you said, people can make a living off taking 5 to 7% gainers.
Yeah.
Swing traders are great.
Yeah.
But if you think you're a position trader and then you say, well, geez, I was a position trader till I got to that first correction, then you really need to think through really your psychology, what really works for time.
Yeah. That's a great point. And I will tell you, John, I do look at, I look at my capital. So if I buy a stock and it goes underneath my buy point, I look at that much differently and much more strictly than if I buy Eli Lilly at 600, it goes up to 800, and then it pulls back to 700 before it goes back. When I've got a big gain in there, I don't call it house money, because it's your money, but I do look at that big profit cushion and say, okay, listen, I'm in the middle of what could potentially be a really, really big winner. And I'm okay to work with my open profits and give it a lot more room to run than I am if I just buy a stock and it starts to eat into my equity. But
that's exactly right. That's why studying those charts of the big winning stocks that go and make a 1 year run or a 2 year run is important, because you're really trying to understand what's normal action in a big winning stock, in a trend. And like you said, some of the biggest winners of all time, they're going to correct 10, 20, 25%. And that, in quote, that's normal, but you have to recognize it. But at the same time, you have to recognize when it's abnormal and you're getting selling clues that it's breaking down.
Yeah. And listen, I'm far from getting everything right, but a perfect example, Vertiv Holdings, I bought it a couple months ago. It started to go up, but then it started to unwind right into earnings. So I cut my position back. I think I cut it back by over 50%, because, if I bought Vertiv at 50 and it's 100, like Nvidia, I'll give you a perfect example today. Nvidia, I held all my Nvidia into earnings because I'm up really big in Nvidia. But Supermicro, I cut the position back by about 40% because I was basically just at about break even. I bought Supermicro. I got, the timing was right, because I bought it last week, the day it was up like 100 points. I bought it, and after I bought it, it went up $80. So I'm like, this is great. It's going to be all upside from here. But then the stock started to pull back. So today it was, when I dialed it back, it was $900. It was up $20 from where I bought it, because I knew going in that the implied volatility for Nvidia was 11%. And I didn't see what it was for Supermicro. I think it was 15. But here's what I knew. I knew that if Nvidia was down 20% and I'm up 150% in Nvidia, that's no big deal. That's fine. But if Supermicro went down 20% and I'm only up by, 2%, I'm going to lose a lot of my capital. So I dialed back the Supermicro position, because I didn't have just any real profit cushion to work with. But earnings, I don't like earning. I've got to tell you, I'm not a fan of earning season whatsoever, but it happens and we just have to deal with it. But
yeah, I hear you. Actually, it's come up a few times in the chat, so I'll bring it up again. People are very intrigued, and they're actually labeling it your upper right-hand chart theory. And they said, I really like this. Can you talk a little bit more about how that is different than O'Neill breakouts? Because I think you're looking for stacked moving averages. So maybe you could just talk a little bit more about that upper right-hand corner, what you're looking for. And the second part of it was somebody said, does volume matter on the?
So to me, the volume doesn't matter. I do know that there's studies done that, it's so I like to see high volume on the breakout, but low volume will not stop me. So if the stock is breaking out, to me, the volume doesn't matter. And the reason I say that is, we can get stopped out on no volume. And I've seen low volume rallies work for a long time. So I'm not against it. But, once again, you've got to experiment with what works for you. But, over 26 years, I've seen too many stocks break out on, let's call it average volume, so that's what I look for. When you say an O'Neill breakout, I've got to say I haven't read How to Make Money in Stocks in a long time. I've read it a couple times,
Yeah.
but so what's an O'Neill breakout? Is it just
generally O'Neill breakouts are typical base patterns: cup with handle, flat base, cup bases, double bottom. But O'Neill's criteria is he wants to see at least 40% increase in the average daily volume. So he does have a requirement on the volume side. Now, the question came up a couple times about settings related to stops. They said, do you set your stops, stop market or stop limit?
Stop market. So the reason I don't use a stop limit is because a stop limit won't always get filled, especially in a fast moving market. So, if let's say I use hypothetically a 10% stop, because if we looked at all my positions, the average is probably 10%. So if I buy a stock here, I really don't want it to go down at all. But if it goes down wherever my stop is, if I'm that far wrong and it hits that stop, then I'm out right away. So it's a stop market, which means that I might not get filled at that exact price. Maybe I get filled 2 cents lower, 5 cents lower, whatever. But yeah, I put hard stops in the system right away. And if they hit, they hit. If they hit, I was wrong in the buy, and I'm just going to get out.
Yeah, I agree with you about the stop market. Lessons learned along the way myself. You say, I want to be a stop limit, and I want to save a quarter. And you're like, and the thing blows right through that, and you're like, oh my God, I lost an additional 5% because I was forcing around about a quarter.
Yeah.
So really think about this. The reason your stop is there because it's telling you wrong on the trade, and you need to get out. And you need to get out. Don't horse around for a dime or a nickel or 25 cents, because you can get really caught, particularly if you're in a stock that has a wide spread of the bid and ask. You could get really caught. So it's an important question. And I would agree that if you need to get out, you got to get out.
and it's the same thing on a buy. And I think we've all learned by doing something that cost us money. I remember probably 23 years ago, I wanted to buy EMC stock, and I decided I was going to get a little cute with it, and I set a limit buy. And I realistically think it missed my limit buy by 30 or 40 cents. And then it went up huge and I missed it. So what I found over time is if you want to buy a stock, buy it. If you want to sell a stock, sell it. But the stops are generally, they're always under the market. So if there's only one reason to buy a stock, because you think it's going to go up and you want to make money. So if it starts going down, then you're wrong in that position. It's just a matter of how long are you willing to stay wrong. And the reason that I use stops right at the buy is I look at the chart, I say, here's my buy point. It should not go there. If it goes there, then, something's wrong and I'm just out.
Yeah, actually, there's another comment that I think is important. Somebody mentioned it got crushed using stop market orders on vertical spread. We're talking about equities here. We're talking about
Right.
stocks. We are not talking about the options, which is a totally different vehicle, different
Right.
bid ask. So, we're not advocating stop market orders on, complex option strategy.
Yeah, I don't use options at all. And then a quick rule, because once again, what I wanted to do is give people, if someone's just looking for an experimental, what's a hypothetical rule? One way is if someone is not sure if they're a swing trader, position trader, is if I buy a stock and it goes up 10%, then I could sell half and raise the stop to break even. And then you've pretty much got a built-in winner, because if you sell half at 10%, the other half gets stopped out at break even, you still sold money. And this is when I discuss with people, because a lot of people I talk to will tell me the biggest problem they have is they sell their winners too early. They bought Nvidia at 300. They sold it at 350 and now it's 1,000. So what I would say is I try not to do I usually scale out of my winners, because I've sold stocks like Spotify and General Electric, and they just keep, I've taken out a piece and they just keep going higher and higher and higher. And I say, well, I wish I didn't sell anything lower, but I'm at least glad I held on to it. So if someone is struggling with how do I hold my winners longer, I would say, if it goes up X percentage, when you would normally sell it all, maybe sell half, raise the rest of the stop to break even, and then let the stock go. As long as you're profitable, let it go and see where it goes on the upside. The worst that you can do is, go back to break even. And that really helped me get over the habit that I used to have of selling my stocks too early.
Yeah, that's a great strategy, and it's worth repeating, because again, this is about psychology. If you are up 10% on the stock and you sell half, okay, you've taken off half your capital. And then once you raise that stop to break even, you basically have a free trade. The second half of that trade is basically free. If you got to stop at break even. And so even if it stopped out, you say, well, I made 5%. So your psychology is still in a winning trade mindset,
Right.
versus keeping the 10% and having it round trip, or maybe lose a couple percent, and you say, boy, now my head is really not in space. So it's about psychology, and that simple strategy in bullet number 4 is burn that one into your brain, traders out there, because that helps you keep your psychology positive.
Yeah, and I use First Solar as an example. First Solar is up 25% in 2 days. Right. So it was 200 yesterday. It closed at 250. If I had, and I don't have First Solar because I said, but if I sold a stock at plus 10% and it went up another 15% that day, to me, that's a horrible trade. You made 10% and then it just took off without you. Once again, if I sell it at 10% and then I just raise my stop to break even, let the stock go to Jupiter, because you're still in there. But that is the simplest way that I know of taking some off the table, raising your stop to break even. That's the simplest way that I know to, to hold your winners longer. So closing positions, and I know we're getting pretty deep into it, and I don't want to keep everyone here all night, but I'll answer questions as long as you guys want, just so you know. But so closing positions can be discretionary. There's a couple ways that you can do it. One of the things that I use the most is I raise my trailing stop. So when we look at some of those positions that I've had for a long time, like Nvidia, Meta, stocks like that, I'll just keep raising those trailing stops, but usually those stops are going to be underneath the 200-day moving average, because to me, the 200-day moving average, that's the final line in the sand, but that's for my really big winner. Now, like I've got Charles Schwab stock right now, and I just raised the stop to break even. I bought it 2 or 3 weeks ago. It was up, I think, 5 or 6%. But when I look at the chart and the way that it's moving, and there's other stocks out there, to me, I'm not willing to give Schwab really any wiggle room. So I raise my stop to break even. And if they hit my stop and it gets stopped out, then there's other places that I can go with that money. So I will use some discretion. I've got a Bitcoin stop that's probably, 20% under the market right now, because I think Bitcoin has so much upside that I'm willing to ride through that volatility to stay in for the big ride. But with Schwab, I'm not willing to give it any leeway. If it works, that's great. But if it hits my break even, I'm going to get out. I've got a General Electric position right now that I think I'm up 50 or 60% in, and I've booked some profits. But when I look at the GE chart, it's getting close to the point where I might close that out and take the money and move into something else. So what I do, I really look at that 50-day moving average. So when I look at some of these longer term stocks like, GE or something like that, if it's working and it's held that 50-day for a long time, then I'll usually hold it. But if it breaks that 50-day, I might cut it loose. Whereas with Nvidia, I'm going to hold that to the 200-day. So I will often look at how much horsepower and potential upside that I think a stock has, and that will determine, where I put my profit stops if I'm already profitable. If it loses a moving average, I could use that as an exit. If it loses a support level, I could use that as an exit. Or the key thing, if I just think that there's a better idea out there, I'm holding GE right now, but I don't have anything in renewable energy. These utility stocks like Vistra Energy, Constellation Energy, NRG, these could have some pretty big moves that are cooking. I don't have anything in solar. And I might just, look at the GE chart and look at all these other, potential bigger upside chart and say, okay, it's time for me to move out of GE. Purely discretionary. Maybe it's right, maybe it's wrong, but that's one thing that I'll do for discretion. But the simplest way is just to keep raising your trailing profit stops. And if it hits that trailing profit stop, then it's out.
Actually, people are clamoring for the explanation of the upper right-hand breakout.
Okay.
So I don't know if you want to finish your last two, 9 and 10.
Well, you know what? Let me see so is my screen share still on?
No, it's off now.
Oh, it is? Okay, hold on. So let me go back let me see if it's back on. Share screen, and then we'll go here. How about now?
Yep, we can see First Solar.
Okay, so what I'm going to do, let's run up. So I'm going to bring up this is my top 25 list for my members for this week. So every week I put out a top 25 list, and it's basically my best ideas across all 11 S&P sectors. So if I fire this thing up, if we look at most of the charts, just to give you an idea, pretty much every chart. So First Solar broke out big, Moderna broke out big, but you can see Qualcomm, every single one of these charts is drifting into the upper right-hand corner. Pinterest, if you just look at where these charts are. So if we look at First Solar, so this was the big breakout, but before this 2-day breakout, if you look at where First Solar was, that was really the top end of the chart. Do you see what I mean?
Mm-hmm.
So, and I'll give you, let me see if I've got this. So I think I do. So here's an alert. So I posted this yesterday, and the stock was $200. This was Tuesday morning. But if you see where the chart was before it broke out, right? So it closed today at 250, but where it was before it broke out, it was in that upper right-hand corner, rising moving averages. So, that's First Solar. If we look at, now Bloom, that was not in the upper right-hand corner. So Lilly, there was one other chart that I was looking for. I had Moderna in here because but we can look at Microsoft. So same thing. Microsoft is in the upper right-hand corner, but when I run these screeners, if we go back to this for a second, just as you go through, let's do this. So Qualcomm, and this is just the top 25 list. Celsius, every single chart, Google, Westinghouse, that's an industrial stock, Dell, but you see the symbols are different, right? But the charts, for the most part, this is a defense stock. I don't even think I pronounced it right. One of my members told me I mispronounced it. But this is a great chart. I mean, this is that uptrend. If all my stocks looked like that, I'd be all set, but that's another upper right-hand corner breakout, Pinterest, Eli Lilly. This is a big breakout. Novo, this stock looks like it's ready. There's dozens of these charts out there, but that's where I want to stay. So when I put this top 25 list, out for my members, while I can't buy, all these 25 stocks every single week, basically, what my business is and what my subscriber base is relying on is the accuracy of the information that I give them. And the charts that we focus on all day are going to look just like that. Upper right hand corner. Nvidia was a phenomenal chart going into earnings, and I posted this on Twitter the other day, that it's a great chart. Charts can't predict earnings. Looks like it's 1003, but it's just a really, really nice chart, going into earnings.
Here's a follow-up question. Do you have a different trading rule of trading these upper right-hand chart breakouts during a choppy market environment?
So yeah, it's a good question. I'm generally less active in a choppy environment. So when the S&P went under the 50-day and it corrected a couple weeks ago, I didn't buy anything at the bottom. So I'm generally not going to buy things at the bottom. So to give you an idea, to answer that question. So this is a trade that I just made, and let's see if I can make. So this is the semiconductor ETF, and I bought this. It was $220 just when it came over the 50-day moving average. So the market corrected. I didn't buy semis down here, but when it came back over that 50-day, I was back over the 50-day. The 10-day had turned up. It was crossing the 20-day. So that was a buy signal for me. But yes, in a choppy market, I'm less active because I know that the chances of the breakout working when the market's choppy might be a little bit weaker. But I generally keep my stops the same. I keep the stops at the same range. And I think for semis, off the top of my head, I think I paid 220, and I think my stop is like 196 or 198. So it's about a 10% stop, but it's underneath. I looked at where this major low was at $200. So I put my stop just underneath that low. Any more chart questions, and then I'll just finish up. I've got one more slide left.
Let's see. Here's a question. Are you typically looking for the home run leader, or do you not mind spreading out your capital across a number of stocks so that your position size doesn't get too large? In other words, if you think Nvidia and SMCI are big winners, is there any point in owning it? TSM and SMH over those stocks? So it's really a question about concentration and larger positions.
It's a great question. It's a great question. And TSM's a great chart that I wanted to bring up. It depends how much confidence I have in the sector and how much money I'm willing to risk if I'm wrong. So in semiconductors right now, I think off the top of my head, in semis, including Supermicro, which is really a server stock, but it trades with the semis. I think I've got 15% of my money between Nvidia, the semis ETF, and Supermicro. And there's a chance if I get brave, I could take that to 20%. I might buy because here's the thing is my Nvidia position, that's a guaranteed winner because I've already made enough money on that. What I'll do is if I want to add more exposure in the same sector, I'll either book some gain. So in the semis ETF, I think I'm up 8% or 9% right now. I could book some gains if I wanted to buy Taiwan semi, or at a minimum, I would raise my stops up. So even though I'm adding a more position, I'm really not adding any more equity risk. So let's say I've got a 10% stop in semiconductor in SM8, and I want to buy Taiwan semi. What I might do is buy Taiwan semi and then move my stop up in SMH to break even or higher. So even though I'm taking more positions, I'm not adding more risk.
Yeah, that's very important. I think I would emphasize that, bigger positions, you have to earn the right for bigger positions. And it comes with experience, and it comes with, you've proven to yourself that you have the discipline to follow your system. You have the discipline to execute your risk management. And, it's easy to say, oh, well, Nvidia is the leader. Just put, 75% of your account in Nvidia. If you're not experienced, you're not emotionally ready, because your account, when you have your entire account in one or two stocks, you can't freeze up, because if something goes wrong, you need to know when to cut it, and you don't want to get caught. So you earn the right to do that, and there's nothing wrong with experience to have bigger positions. So I'm not advocating not having bigger positions, but gradually through experience you build your position. You say, well, I'm comfortable with 15%. Then maybe then it's 20, then it's 25, and depending on your psychology, you might be comfortable eventually saying, I have 50% positions.
Yeah.
But that's a risk tolerance thing, and everybody's.
Yeah. Here's the thing. I would back into it and just say, assume that you're going to be wrong. You put 100% of your money into Nvidia and assume that you're going to be wrong. How much money are you willing to lose? So if somebody's got 100 grand and they put all 100,000 into Nvidia, it's important that you say, okay, if it goes down, whatever your number is, 5%, 10%, whatever. So I don't think it's that big of, to take a bigger position isn't that bad as long as you have a stop. Where people run into difficulty is they load up on these stocks and they don't have a stop. And then it starts to go down and they say, well, I can't take a loss because it's the greatest stock ever. And then they're down, 40 or 50% and they blow out.
Okay, let's get back to the 10th, your last point, which was number 10. Just
Last
so we make
slide,
sure we don't,
okay,
so we don't skip it.
Yeah, we'll go. And this is just the final. Let's see if I can, let's see from the current slide. There we go. So this all comes down to mindset. And what I will say.
Actually, I can't see your slide. We're looking at your TSM. You got to switch
hold on.
the screen share.
On.
Yep.
Screen share. My bad. Hold on. New share. And then we'll go here and then share. Is it there?
Yep. We're good now.
Okay. So here's the thing. Trading is, if you talk to most experienced traders, they'll tell you that trading is probably 60 to 80% mental. And the charts and the indicators, everyone uses something different. But I keep these in my office. And this is from Paul Tudor Jones. This is from his interview in Market Wizards. But just quickly, if he's a billionaire and he became a billionaire from trading, he wasn't born into it. He was a self-made guy. But if you look at these things, the market's going to go where it's going. If you read this and you read social media, they're not the same thing. The market's going to go where it's going to go. The media and the news, they want to tell you where the market's going to go. He says it's going to go where it's going to go. You always want to be with the predominant trend. At the end of the day, your job is to buy what goes up and sell what goes down. And you can read the rest of these, but basically what he's saying is you have to be humble enough to accept that the market is bigger than any one of us. The market doesn't care what anybody thinks. It's going to do what it's going to do. And your job as a trader or as an investor is to be on the right side of the market, not to predict, the recession's going to happen or Nvidia is going to crash or, we see all those guys on social media, they've been predicting the end of Nvidia since it was $200. The market's going to do what it's going to do. If we want to make money, we need to get on the right side of the market and figure out how to get that done.
Yeah, I think also number 15 is a great one. Don't focus on making money. Focus on protecting what you have. And This is all about, we've talked about it tonight. Larry's laid out, how you got to really approach risk first. How much are you willing to lose? Where is the stop? Does it make sense on the chart? Yeah, and you have to accept, if you're going to say, I'm going to risk whatever, $2,000 on a trade, you mentally have to say, I'm going to not have that money. And it's amount and I'm okay with, because, too many people look at it and just say, oh, I'm going to make a killing. I'm going to put my whole account into Nvidia tomorrow, and this is going to be great. Protect what you have is number one. And you have to do that by putting risk first to evaluate the risk reward of the trade. It's so important. And it really distinguishes between people that are, bring more of a professional approach to trading versus just simply, I'll say, gambling.
Right. Yeah, you have to treat it like a business, and I think you have to have something that's repeated. And like I was talking about, I've got a subscriber base. I can't say to my subscribers, "Hey, I'm going to buy Super Micro, and I'm going to cross my fingers and just hope it works out," or anything, General Electric, whatever it is. You've got to have a discipline. You have to treat it like a business, and every single business is going to have some acceptable losses. If we opened up a restaurant, we're going to have some losses. If we open up a law firm, we're going to have some losses. So the winners will often take care of themselves if we don't micromanage them and get shaken out every time there's a down day in the S&P 500. And that's where you make your real money is once you hold some winners for a long time and you don't have to be scared of the drawdowns or be scared of the red days. And that's where the winners really start to stack up. So I want to have big winners and keep my losers fairly small.
There was a question, not a question, a comment. Number 13, I do not agree with. Demand is first. 13 is, I always believe that prices move first and fundamentals move second. I agree
think
with
when
Paul.
they say,
I agree with Paul Tudor Jones, because how many times do you see a stock gap up, move, and you shake your head and say, well, why did that happen? And really, when we're talking growth stocks, it's the lure of future earnings which drives growth stocks. It's not what happened in the last 2 quarters earnings reports.
look, oftentimes, how many times look at Tesla? Tesla recently put in a bottom. I don't know if it's the final bottom on horrible news. Their quarter was bad. Sales were down. Earnings were down. Everything was down. And the stock was up like 6 or 8%. Stocks will often bottom on really bad news. So that's a situation where the price moved well before the fundamentals did. And stocks can often top out on great news, which is another price where, if you see a stock get great news and it tops and it reverses lower, then, that's something to pay attention to.
Yeah, that's also another key thing. You always sell stocks on the technicals. If you wait for the fundamentals, you'll be late, because the fundamentals don't show up usually for a quarter or two later. So it's important to, you have to be able to read charts to at least a basic level.
Yeah. And he's not saying that fundamentals don't matter, but what he's saying is that the market will often sense something before it actually is, made news. And that's all I've got, unless there's questions.
Yeah, I'm just kind of searching through my notes here. I took some
yeah. Take your time. I got nothing else to do tonight, for real.
No, I think you're, I just want to kind of capsulate, because I think what really becomes apparent from your 10 points is, you have clarity of what you're trying to do. You obviously have discipline and you know what you're looking. You've shown us a series of rules that you work for you. So it's really, and this is all part of, this is part of Larry's methodology. And we talk about it saying, his methodology, some of the pieces may work for you. It might not all work for you, and that's fine. Eventually, you've got to adapt to what works for you. And that's why sometimes I think, when you're on X and you're on Twitter and you say, well, I'll just get a copycat, so-and-so, that doesn't necessarily work, because some trader that's very successful might not have the same psychology that you do. So even though you think you're going to just say, well, I'll just copy and do what they do, you might not be able to execute with the discipline that person does. So eventually you need to, grab the pieces and develop your own system and make it holistic. And I think it does mean looking at, what do you use to evaluate the market? What do you do to find the strength of sectors and relative strength? And then what are you looking for in individual stocks relative to the charts, relative to the fundamentals, or one or the other, depending on what works for you. But consistency is very important. And most traders, when they go through a rough patch, they basically abandon the strategy and they just say, oh, well, I'll try options next, or I'll try value investing. And, hopping from strategy to strategy is usually not the best.
Yeah, I just wanted to put the rules back up so that, people could see, the key thing. I think the key thing for me really is just to keep it simple. There's a lot of people that make money in different ways, but I just disregard what everyone else is doing. And as long as my way keeps working for me, which it does, I'm happy with that. I'm married to my wife. Maybe there's someone else out there. Maybe Scarlett Johansson, thinks I'm a handsome guy, but I'm staying with my, she probably doesn't, but I'm going to stay with my wife. And that's the way I look at my trading system is, this one works for me. I'm super comfortable with it. I get really, really good results from it. And there's just no reason for me to change it.
Here's a question. Somebody said, Larry mentioned automated filters on FinViz. Are there ways to set the filters and get automatic updates like emailed to you?
I don't think that FinViz does that. I don't think they do. I know that stockcharts.com does do it. And I use both frequently, but Stock Charts will send you an email. I don't know that FinViz does. They might. I've just never looked into it. I do like to get in there, and once I get into my screen, I like to filter through a couple of things. So I'm just actively in there. What FinViz will let you do though is preset it. So you just hit the button and it'll constantly refresh with whatever the alerts are.
Yeah, a lot of nice complimentary comments to you, Larry. Great presentation,
Thank
great
you.
great concepts.
Thank you.
People really enjoyed it. I enjoyed it. I think there's just incredible bedrock of good common principles here that are bedrock of any system. So I think it's a really good holistic view, and I hope everybody got something out of it.
Yeah, thank you everyone for joining. I appreciate your time. John, thank you for having me on. And just glad to be here. Thank you.
Subscribe to the Blue Chip Daily YouTube channel for more technical and trend analysis videos and other content.